and create a stage for everybody to network. Sergey is going to pass around these little handouts, and you'll get a lot more value from this talk if you decide to follow along. It's totally optional. To add to that story, when we went out to dinner, it was just me and Sergey and a bunch of his buddies, and I was like, you should be so good at underwriting, you can do it on the back of the napkin. And one of them said, you should do that, Wayne. And I was like, okay, let's go. So we underwrote a deal on the back of a napkin sitting at a restaurant we'd never been at. They put me to the test because nowadays I have a couple people that help me underwrite all the time. And so maybe I was getting a little rusty. But that's the whole point of this talk, is to really get you to, whether you're an experienced investor, to remind you of what your strict criteria should be and to bring you back to focus in your strict criteria, which I would call your buy box or your underwriting criteria. And if you're new, to help you establish some fundamentals, some groundwork to set you up for success. I've been known amongst my circles of friends and real estate investors to be very conservative in my approach. I think my risk tolerance is a little lower than most, but it works and it's consistent. And it may be boring at times. It's not hot and sexy like Airbnb was, coming out of COVID, or how midterm or what's shared living is now these days, and all these other things that come around, but it is tried and true. Can we pull it up? Sweet.
Do you have any? I think a couple people don't have slides. If you have any extras, or?
Nope, that's all I got. I was literally printing them out as fast as I could so I could get here on time. So if you don't want to use it, share it with someone else. If not, share with a neighbor. All right. So who am I? Well, disclaimer: this is not official advice. I'm not a lawyer. I'm not a real estate attorney. Any of those things. I'm not a CPA, but I've been at it for 10 years, and I've had a lot of people pour into me over the years, and that's been great. So I try to give that back. I'm a husband. I'm a dad. I'm a coach. Who's football? Soccer fan? Anybody? Are we having a good time right now? I love watching the World Cup. So I've been coaching soccer. I finally hung it up in December. I coached it for about 19 years and ran a soccer league for 10. But all my kids are grown, and I was no longer coaching my kids. I was coaching other people's kids. Love the sport, love the game. Never even played it as a kid. I just went into it with my kids and learned to love it. So been a coach for a long time. And that's just in sports. I tend to mentor people, so I could be a coach in that sense. A friend, a nurse, I recently left my healthcare career of 27 years last December to pursue entrepreneurship and real estate full-time. Took the jump that everybody talks about, probably in the worst part of the market cycle. But hey, you know what? Go big or go home. And then an entrepreneur. I've always been an entrepreneur at heart. I've been doing real estate on the side while working full-time and raising a family and doing other nonprofit things. And now's the time for me to shine and really do that for the next 10 years or more. So yeah, NorCal Properties and Investments. I still serve on 2 nonprofit boards, one for veterans and one is a small bootstrap organization locally that does a haunted house event every year and raises money. They've raised over $150,000 for the community over the last 10 years, which is super cool. And I started building companies this year, which is, if you could add more to that, I started a heavy civil construction a company with a partner, an experienced general partner, so moving dirt, big equipment stuff in the civil space, and that's been fun. And then I've been managing my own portfolio in Northern California for so long, so why not start a property management company? Yeah, so we started that. Gonna slow grow that, nothing big, nothing fancy, just my goal is to get to 20 doors under management by next year. Just something small, grow it slowly, right, organically. And you know what, it's already moving, which is great. And then Capital City Real Estate, we started 3 years ago, officially when we started investing out of state. We started investing out of state 5 years ago, but we realized that we needed a more local presence in the out-of-state markets. And so we started Capital City Real Estate, which in turn started to be a wholesale company because that was more of our acquisition company. And so starting in 2 weeks, I'll have wholesalers working 7 days a week for the first time in 3 years, which is really exciting for me. So really excited to lead these teams and share the knowledge. And that's just a little bit about what I'm doing, how I stay busy and all those things and whatnot. So let's get to it. So when you start in real estate or when you're in real estate, you want to know why you're doing it. What's your big why? For me, I wanted I wanted retirement income. I watched my parents lose a lot of their 401k and their retirement stuff in the great financial crisis in 2009. They extended their retirement deadline. I don't need this, but I'm going to keep using it. So they extended their retirement deadline by like 5-10 years. And I was like, that's not going to be me. That's just not going to be me. I want to have control of my own destiny, where my retirement dollars are going. So I said, well, what can I do? I always had an affinity for real estate. I missed out on my first real estate investment off a family member. What was it? It was a probate sale, and I was 20 years old, in the military. I was in the Army. I forgot that. I'm an Army veteran, served for 8 years. But I was in the Army in Louisiana, and I couldn't figure out how to get $30,000 to buy this triplex out of probate from a family member. Come on. Like, everybody's like, yeah, right? We all know now. Like, I couldn't figure it out. And so that kind of frustrated me. And then I was like, okay, how do I buy a house? So I started to learn that a little bit. And right when I got out of service, I was ready to buy my first duplex, but I got too scared. I had some money saved up. I was like ready to go. And I got too scared, so I pulled out of it. Should have totally done it, because that would have been the best house hack on the planet. And it would have doubled in its price since then. That would have been 2008, 2009. So anyway, for me, it was retirement income. As my career grew in healthcare, it was also tax benefits and a hedge against inflation. And I've had fun the whole time. I would say, like, there's been times where it's feeling a little stressful or frustrating, but like for the most part, it's been fun. So I think at the beginning of it all, why are you here? Like, why do you want to invest in real estate? And that's going to help guide you for the rest of your journey. And you stay true to that. So for you, you got to decide that. Did I cover them all? Cash flow, appreciation, tax benefits, retirement income, hedge against inflation. Yes, and it's fun. So building my buy box, minimum cash flow numbers versus pure cash flow. So everybody, hopefully I'm not making this up. Hopefully you know what pure cash flow means. And if you don't, I'm going to make sure you know it tonight. Cash flow isn't the income minus the general expenses. It isn't just that. It's a whole lot more. And that's one of the things I want to share with everybody tonight. I learned that early on, and it saved my behind so many times. And then you want to know, like, well, what's a good return? Like, what should I expect on my money? You figure the stock market brings between, the last couple of years, 5-10 years, it's really bumped it up, but it used to be 7% over the life of the stock market. Now it's up closer to 8 or 9 or something like that. But because they've had this huge 20-year run, it's just crazy. But you want to know what's a good return on my money. Like, how much money should I be making? How much money cash flow should I expect? And you need to create that for yourself. Mine's very simple. It's $100 a unit if it's more than 2 units or 4 units, and if it's a single-family home, it's $200. That's it. That's all I want. Bills are paid. I got all my savings in the bank. Everything's covered. And I'm going to talk about that pure cash flow thing some more. And what's your minimum cash on cash return? For me, it's 8%. That's conservative. There are plenty of investors in this room that are probably got less than 8% cash on cash return for their investments. And I'll tell you what, 8% is a tough number to get sometimes, especially right now. It wasn't, back in 2021 when the market was appreciating like crazy coming out of COVID, but it is now. So you want to make sure that you know what you can expect to get on your money that you're putting in. All right. And then I always have an exit plan and a backup exit plan. If I'm going to take down a flip or a burr, I want to make sure that I know that I can rent it out. If I'm going to decide to do a short-term rental, which I've done that, I want to know that it also makes money as a regular rental, so that if I have to pivot in my strategy because something changed, that I'm still going to be successful in the property. And that's super important, especially for someone who wants to flip. You don't want to get stuck with a loan having to pay one of these guys. Okay, no shade on them. They're doing what they need to do. But if you can't exit on that property and you need to convert, you need to be able to convert to a long-term debt solution, number one. So you need to be financeable long-term, and they probably have both of those packages for you. And number two, you need to make money off of it. So, or at least hopefully break even. But that's not the point of this talk. This point of this talk is to get you to a spot where you're looking at investments from a conservative lens and you're making money when you buy, not when you sell or refinance, okay? All right, so phase one underwriting. I kind of talked about this, but it's really just a basic investing criteria used to determine the viability of an investment. And so this is on autopilot. I don't even do my phase one underwriting anymore. I have 2 assistants that do it full time. And it's a beautiful thing because we have deal flow that's crazy. Like the volume is significant. But that doesn't mean it's good. You know, that doesn't mean the deal's good. And so we got to make sure that it meets that minimum criteria before I even look at it. It's quick and it's easy. It's a very basic filter. Who's heard of the 1% rule? Okay, half the room. So the 1% rule essentially says the income should be 1% of the purchase price. That's a very basic criteria to weed through lots of properties. So if you're surfing the MLS and you're like, okay, I know rent for this part of Sacramento is $2,500 a month. I need to know that my mortgage is going to be, or my purchase price is going to be $250 or less. And that's just a random example. I don't know if that's real in Sacramento, but it should be quick and easy. And again, used to filter through deals. And it should be the first step in formulating an offer, whether it's off market or on market, it's still an offer. If I go make a transaction with Josh right now and I'm still making an offer, even though we're talking, right? Like, so like, just think about it like that. Not like an offer is something that you're putting on paper. Like literally an offer could be me and you talking and we come to terms. So, but if you know your underwriting, you can start to do that. So the 4 square method, if you haven't seen this, I'm going to show it to you tonight. I didn't invent it. It's been around for a long time. It essentially shows the income and expenses, cash flow, and your cash on cash return. And if you go through this method, this is the back of the napkin math that I'm talking about. It's very basic, but it's very easy and it's very tried and true. So you're going to go through all those. You're going to try to get to your goal. Now I said my goal was 100 to 200 per unit, or 8 to 10% cash on cash return. So who wants to buy a duplex? Only one person? Okay, that's better. I need to work up. All right, I want to buy a duplex. I want to buy a bunch of them, especially at that price. All right, that's very real. And so we're asking $87,900. It's in a Class C neighborhood, Class C area. So not the best, but not the worst. Could use a little bit of light remodel to increase the rents at turnover, and it's located in Springfield, Ohio. Who knows where that's at? Okay, a couple people. Cool. So that's the duplex. All right, so this is the part where you start to follow along. That's the asking price if you're going to start to do the underwriting activity. And if not, that's cool. All right, so the income, we're going to use tools that are available to us, are available to everybody. There's more tools listed that are not listed here that I'm sure everybody could share. But Rentometer is really good. It's pretty cheap. It's like 20 bucks a month or something. Zillow, if you know how to do all the filters and zoom in on the neighborhood, is really good at rent values. So you can tell you like what's available now, and then you reduce the days on market like and expand them to see where it's at. So that's a good one. Actual rents, which are either in the agent notes sometimes on the MLS or on the lease agreement. So part of your documentation discovery, if you're making an MLS transaction, should be to request the lease agreements of the existing tenants. You don't have to run away if they say don't have them. It's okay. But you do want to see bank statements to make sure they're paying the rent. All right. And then potential rent. So you want to go back to one of these things or use Rent Cafe and look at like, okay, this is what they are paying and this is what they could be paying. So is there a difference? Is it rented under market value? Those kinds of things. You want to know these things as you're going into it. And so when I underwrite a deal, I underwrite it at both. So we underwrite at market and we underwrite at current rent. So if it's vacant, obviously we would use market rent if we could get it. And if it was tenanted, we're going to underwrite it at tenant rent. Not that we're going to get up there and raise rent really quick, but we definitely know where we're going with the investment, right?
Question?
Yes.
For the potential rent, just to clarify, how is that different from actual or average rent? So is that like your target potential rent that you can get if you like after renovations, or or like to maximize the maximum you can get from the property?
Good question. That's a great question. So average rent, right, is the whole neighborhood. It's the whole area, right? Actual rent's what they're paying, right? What they're actually paying. Potential rent is if you added value. So someone said forced appreciation. I think it was Russ. Forced appreciation, which you get in there, you give it some love, just like you did with your mobile home, and you raise the rent, right? That's forced appreciation. Paint, carpet, hopefully nothing major, but like make it look nice again, right? So that's the potential rent, and that's your 90 to 100 percentile on your rent analysis. So when you're sorting through Zillow, Rentometer, all these tools, and Rentometer actually breaks it out by percent, and you can see literally in front of you what the 90 to 100 percentile is. But those properties are going to command the highest rent because they're the best looking in the best neighborhood with the best amenities, right? So if your property doesn't fit in that box, don't get shiny object syndrome and think you're going to get that kind of rent, because you're not, okay? So just be thoughtful about potential rent. Everybody wants, we all get it. We all get excited when we see, oh yeah, that house rented for $2,000, Jake, and I'm going to rent this thing for $2,000. It's only rented for $1,100 right now, and I'm just going to make $900 a month. No, it doesn't always work out that way. And so you just have to check yourself. You have to be careful and be conservative about it. So thank you for asking that question. Bonus income, this is my favorite. So storage, right? I've got a property right now that I could rent out a 2-car garage for storage if I wanted to, but we're gonna convert it eventually to a short-term rental. So it's staying empty until we can get to it. Laundry services, if you have shared laundry of any kind, I know that the paid coin op or the digital laundry thing is like $800 to $1,000 more than a regular laundry setup. Do it, it's worth it. Especially if it's in like a shared setup with multi-family, like 2 to 4 units or more. If you're doing bigger apartment complexes, yes, those already exist. It's kind of part of it. And then back charging utilities. Sub-meter installation in California is probably like $1,500 to $2,000. And then annual monitoring is about $300 a year. I think $300 to $400 a year. How much is your water bill? Do the math. It pays for itself in the first year or two. And so it's an investment up front to get in and sub-meter, but it's worth it. And but you have to have the right stuff, and you have to have it set up, and you have to do it the right way. And so you can't just split the bill and say, oh yeah, you took 60% water, you took 40, so you pony up. That's not how it works. In other states, you can kind of get away with that, which is kind of crappy, but it's also an investment up front, especially if you're taking down drywall or you're doing things where you're going to be disturbing those areas, and you can install them at that time. So just think forward. The back charge utilities thing, it's a little bit of a headache. Maintenance thing if you're going to hold it, but it's worth it long term. Okay, income. All right, so back to our case study. So our average income for this property, this duplex, is $744 per unit. The current or the actual rent is at $600 in one unit and $775 in the other unit, which were in the agent notes. And eventually we could see that on the lease agreement. Do you want to buy the duplex now? What was the listing price? Anyone remember? Okay. All right, these numbers are looking pretty good. All right. And then the agent broker sees potential for growth in the area and recommends a 5% increase in rent over the next year. And I would look at potential rents. One of the things we didn't talk about is the power in this room right here. Who's got a rental within 100 miles of here? Okay. So, hey, what are you renting for? What are you renting for? Am I in the same neighborhood? Start talking about it with people. Like, I'm looking at this property. You might have it in the same neighborhood, David? Same neighborhood as David, and he knows exactly what he's doing with that property, and just start talking about it with people. I've met people on airplanes and at random places traveling that we just invest in the same place in Columbus, and it's just random. Now we're friends and we share deals all the time. Like random. So I just say that to say that like this networking thing is super powerful, and if you take it beyond this room, it's even more powerful. So again, potential rents. Rent cafe is good. And then we talked about bonus income, the storage. In this property, had a mud room that was actually, look at 20 by 21 feet building in the back. That's almost like a 1-bedroom house in California. Like, you know what I mean? Like, that's decent. And then it had shared laundry in the basement, which is common in Ohio. A lot of Ohio duplexes don't have a split basement. They have a shared basement, which is creepy and crazy, but they had shared laundry facilities in the basement. And so you could back charge utilities on this as well. So there's opportunities on this property here. Okay, expenses. Still one of my favorite is the Zillow mortgage calculator. All right, someone asked what interest rates are. You can look at those every day through Google. The Wall Street Journal publishes them daily. As long as you know who your lender is and what your point criteria is, talking to these guys, right? You know what your interest rate is every day. I know what my interest rate is, 1.5 to 2 points as a non-owner occupied investor for single family to 4 units. And so if the current prime rate was, let's just call it 3% for fun, I'm going to pay 4.5 to 5% interest on my properties. So I know that because I do these numbers all the time, and I've like these are the tools that we use. So I go to Mortgage Zillow, and the calculator, that thing's awesome because I can just plug it in on my phone. And it shows me the 10, 15, and 30-year amortization rates, and you can kind of look at your interest rates and what that cost is going to be. It breaks it down by principal, interest, and gives you a guesstimate on insurance and property taxes. Don't trust it, but it's a good little calculator to use, and it's free. Property taxes, literally, I should have changed Google to AI, because all you got to do is put the address in now, and it will give you the property taxes, which is great. Property insurance, kind of wild card in California. If anybody knows, I mean, insurance has been in a crisis in California for a few years now. But out of state, it's decent. So if you're investing, you want to build a relationship with an insurance broker, someone that you can just send an email to and say, hey, give me an insurance number. And then by the time you do that a few times, you'll have a good idea, like in that area, like what you should budget for homeowners insurance, property insurance. HOAs are important. Don't get caught with one of those and you didn't know about it. I've seen HOAs range from $50 a month to $800 a month. It's just crazy. So that's important. Utilities, I mean, if you're paying for them, you want to know about them, but otherwise it's not your problem. So just kind of bonus. And then understand if there's shared areas where you need to do responsibilities. So a good example, I have a 3-unit property here in Northern California where there's shared landscaping, and one of the tenants I inherited did all the landscaping. And that was part of their security deposit when they moved in. Well, they moved out. Guess what? Nobody wants to do landscaping. Right? Someone's been doing it the whole time they've been living there, and now I got to foot the bill. But I'd already planned for that. So I incorporated in the rent hikes and got a landscaper to come in and start doing that. It's no big deal. But if you have snow removal or landscaping services that need to be done on your property to keep it going, you need a budget for that. And then vacancy. Here's where we get into conservative stuff. Everybody knows what vacancy is, right? Someone moves out, you don't fill it up for a month, that's your vacancy. So 5% is what I recommend. 1 month vacant is 8.8%. Like, that's a big deal. So if you made, let's do some back of the napkin math here. If you made $1,000 in cash flow, 8.8% is $88. You'd lose $88 on that cash flow for the year, if not more. And that's just your cash flow. That's not counting you having to cover the mortgage. Capital expenditures, You want to make sure that you're looking at big ticket items. So this is huge. So when you're looking at properties, and you're looking at the age of the property, which is important, but you really want to look at like what's happened to the property since it's been built. You know, if the roof is shiny, it's going to need a new roof. If you can see that reflective material, the fiberglass, it's going to need a new roof in the next 10 years, maybe sooner. That's a capital expense, right? Hot water heater, how old is it? You can go take a look. You can have someone take a picture. Where's my home inspector? You take a picture of that tag every time, don't you? So it's in your report when you buy the home inspection. That's what we pay this gentleman and his crew to do, is to get that information for us. But if we don't use it, then what are we paying for? So you want to know what's the average life expectancy of a hot water heater?
Hot water heater?
I'm putting you on the spot.
Like 10 years.
It's 10 years. So if the hot water heater is 10 years old when you buy the place, you know you're going to buy a hot water heater soon. Sometimes they run forever. Like they'll last for 15, 20 years and just all of a sudden blow out, and sometimes they last for 4. Okay? But that's your capital expenses. So you want to know that going into the property. If I'm buying a turnkey, brand new developed property, which some of those exist, especially now when developers are trying to get off inventory during the slow market, it's great. I'm not going to budget 5% for capital expense because I got a developer 1-year warranty on everything, number one. Number two, everything's brand new. And number three, by the time I need to replace something in 5 to 10 years, if I just did 1 or 2%, I'd have plenty of cushion to replace that hot water heater or, whatever that was, right? Maybe there's a flooring section that needs to be redone, some carpet, that kind of stuff. So that's where capital expenditures can change. I do recommend you start with a hard number as an initial screening criteria of 5% or something close to that. And then as you're looking at the property a little closer, you can move that a little bit lower or higher even. Like if you know it needs a new roof, budget for it right out the gate or move that number right away. Because if you're gonna sit on a roof that you know needs to be replaced in 5 years, you're gonna be in trouble when it starts leaking and you're gonna need to pay for it. Property management, that's a bunch of phone calls. Just call around in the area, see what their going rates are. You can interview that. I prefer an interview style. I like to interview property managers before I go to do business with them. So just fake it till you make it, especially if it's your first one. Be like, hey, I'm a real estate investor. Can I ask you some questions about your property management?
Yes, and then please make sure you review the contract with the property management company. There was a time, just like you said, I interviewed property managers. One of them sent me the template that I would sign, and it says they will own 6%, not of the rent, 6% of the property.
Oh,
Right?
what?
So, please be
Let's get that notarized real quick, okay? That's crazy.
insane.
Yeah. Okay, that's a good point. I'm going to go on a soapbox for a minute. It's a lot of paperwork in real estate.
I think
Read it.
I think now you can avoid it. Just upload it to Claude, and Claude is gonna keep going.
So property management fees, 10% is a good number across the board nationwide. Sometimes if you build a relationship, you can get less. If you have more than one unit with a property management, you better bargain for less because that's just standard, industry standard. And so keep that there. Repairs and maintenance, another 5%. So repairs and maintenance are the simple things. The broke wall plates, the door handle, door jamb busted out, the clogged toilet. We started getting these little stickers for all the long-term holds that you get from Amazon and putting them in all the rentals that go to the shower drains so we could minimize our plumbing issues. And they're great. So it's $20. Give them to all your tenants. Tell them please change it every couple months. And it just adds a layer of protection. And for $20, for a couple of years, it could save you on a $200 plumber visit to go snake a hair laundry soap ball out of the P-trap or the clean out. So things like that. That's where your repairs and maintenance are at, right? And so those are the things that are going to come up. These come up in brand new buildings. They come up in old buildings. It just happens. So you got to plan for that. So we're at 5, 5, 10, 5. We're at 25% of our cash flow that we're designating for these items before we get paid. All right, so just keep that concept in mind. That's really what I'm trying to bring across here is where those expenses go. All right, so back to our case study. So the mortgage on this duplex during that time would have been $541. Now it's probably, quick back of the math. Come on, what do you think? 87,000?
What was the question?
What's the P&I, the principal and interest?
What was the
87.5.
P&I? Probably under 1,000, between 500 and 1,000 maybe? 1,300 a year.
How much?
1,300 a year.
1,300 a year? Month.
Yeah, per month. Yeah, so the 87,000, if you take 6.5%, right, that's your yearly payment, which includes principal and interest.
Okay, so definitely more than what this was when I wrote it 4 or 5 years ago. But still, we'll just use that number for fun. Property taxes were 2022. Insurance I left out, I didn't have that number. HOAs, there are none. Water and sewer is disclosed because remember the owner paid for them, so it was $100 a month on average. Landscaping and snow removal, there was none, even though there probably should have been, because you see these steps right here coming out of the building. In Ohio, even that's your responsibility if there's snow on the ground. So yeah, I have a pointer. Forget about that. So landscaping, snow removal, vacancy 5% would have been 5% of my total income, which is $69. And then capital expenditures at 5%, again, $69. Property management fees at 10%, which this is a duplex. I would have bargained for an 8% minimum on my property management fees because they're getting 2 units for the price of one. And that would have been $137. And then repairs and maintenance would have been $69. So if anybody's following along, plug those numbers in on your expenses. All right, cash flow. So this is what's left over. That pure cash flow number after that 25% is gone, after all your bills are paid, and then you multiply that times 12, and that's your annual number. Okay, pretty straightforward, and it's on that sheet for you as well. All right, so your cash on cash return. Really, the definition of this, if you don't know it, is how much money did I put into this property? Let's just call it whatever, 20% plus some 5% to fix it up. So we got 25% of this. It was less than 100. We'll just say we got about 20 grand into this property. And the closing costs and all those things. So all of that money, and then you amortize it against your annual cash flow. So you're gonna use those numbers at the end to remove your total investment divided by your total cash flow times 100, and that's your percentage for your cash on cash return. And remember what I said in the beginning, my minimum for our investments is 8%. On the slides I put 10 plus because that's really sweet, but 8% is a good happy medium. You'll see that properties are still good investments in appreciating cycles less than that, but for me and for the investors that are with me, we really aim for that 8%. Sometimes as you get deeper into the deal, that number can go down a little bit below 8%. And you got to make a decision like, okay, we really scrutinize this deal. We're through like 3 or 4 rounds of underwriting. We had some really hard numbers, and now we're at 7.5. All right, but we've spent a lot of money and time to get there. It's still a good deal for us. And we're looking at the 10, 20, 30-year trajectory. You know, what is the life of the investment? Are we planning to hold it for 5 or 10 years for a whole market cycle? What does that look like? And then if we think that appreciation cycle is going to bring us at least 1.5 to 2% over the next 10 years, then 7.5% isn't too bad, because by the time we get to exit, we'll be much higher than that. And that gets a little complicated, but back to the basics: cash on cash return on that spreadsheet, easy as pie, and it will give you that number for you. So, here we go. Down payment was $17,500. Closing costs were $1,750. Rehab budget was $10K. Total investment was $29,000 and some change. Our cash on cash return was 1.18%. Deal or no deal?
It's in Ohio, no deal.
He said no deal. I love Ohio, certain parts, but that's okay. Not Springfield though. You know, and this is where I said, this is where it comes back to what you expect for your money, right? And so we're looking at, we would offer 70K and see what happens and go from there. All right, questions?
You said you did this like 4 or 5 years ago. What are you looking for these days? Are you still buying in that area? Kind of how has your criteria changed over the years?
The criteria hasn't changed. That's a great question. So we currently invest in 2 out-of-state markets, Columbus, Ohio, and Oklahoma City. Columbus, Ohio has appreciated 23% in the last 6 years. It's the only Midwest market that's outperformed like that, and I don't know forever, but very, very, very much so. So Columbus has been great. We've been on the tailwinds of that. It's stabilizing, which is a good spot because a lot of people went there really quickly over the last few years, and it got super competitive for us. But now we're starting to see really good deals again because it's thinned out the market, and the rents and the costs and all those things have started to stabilize, which is good because it's going to continue to appreciate. And then Oklahoma City, don't sleep on it. It's coming. So I hate to say that in an open room, but hey, I'm bringing you with me. If you want to look at deals in Oklahoma City, we can get into single family homes that cash flow with this criteria for 30, 40 grand out of pocket. So think about like that for a beginner investor or someone who wants to diversify and they got a little chunk sitting aside, right? Like that's a good opportunity. Was that a hand?
Yeah, so you said the property management fee, you should like allocate 10%. Was that for those markets, Oklahoma and Ohio, really? Or was that just general national, like the national property management companies? Only because in Sacramento, I've interviewed like 20 property managers, and it should be around 8%. Like I'd say 7-8% if they're like really good, maybe 8%, and then like honestly you can get people at 6%. So 10% sounded kind of high.
Yeah, so that's like a national average, right?
Okay, so that's just
California has the highest rent on the planet. So property managers cannot charge 10% here. They used to, back in the day, but then as rent grew tremendously over the last 20 years, it didn't seem, I mean, to me, I wouldn't want to pay 10% on a property that rents for $3-4 grand or more. That's a significant haircut on that investment. And so, yes, good question, nation average, but remember, call your property managers in the area that you're looking and just interview them. You'll get that information just like that. So yes, so we still invest in Northern California. I'm doing a couple flips right now. And yeah, Northern California is great too. You know, it's a great market.
When I'm piggyback on California, you mentioned, piggybacking on California, you mentioned that you want your cash on cash flow to be 8%. Is that even viable in California? Is there such thing where you cash flow from moment zero in California?
There is. There's this thing called the BRRRR investment. Have y'all heard that? Buy, rehab, rent, remodel, refinance. If you do a forced appreciation and you don't cash out all of your money, you can still get those numbers. But it's really hard to get those just buying in. You know, it's a balance, you know, do I want all my money back when I refinance, or do I want to leave some in the deal? You know, if you get it all back, it's an infinite return, right? But then are you actually cash flowing when you pull all your money out, or are you risking being too close to your expenses, right? With vacancy and those kinds of things. So yes, it's possible in California. It's just, you got to really get after it. It's not, you're not going to find it on the MLS every day. That doesn't mean you can't, but you're not going to find it. And if you find it, just get it. Get it done, whatever it takes. Just get it done, because if someone else finds it, they're going to take it. They're going to figure it out.
So I also just want to comment. You could do 8% because I'm doing deals that are 8%, but it's 3 functions. number one, it's got to be an off-market acquisition, so you're not paying MLS price. Number one, and number two, you have to put at minimum 40% down, if not 50% down. So it's a direct function of how much down payment you're willing to do. Because if you put more of a down payment, if you put 90% down payment, yeah, you'll get 10% cash on cash. But then the question is that a good use of your equity, right? Putting 80 to 90% down. And so if you're gonna do 10% down or do a FHA loan, 5% down, you're never gonna get 8%, right? But if you are putting, 40% down, 50% down, there could be a chance you're going to make about, and it's off market. You have good TI, costs are manageable. You can do 6 to 8%. I've seen that done, but you need all of those factors on your side.
Great question. So yes, we can do it
You
here.
can also try seller finance if you be creative. So you can have a spread at least 2%, right? Let's say you have your mortgage is, let's say, 6%, you may have the seller finance at 4%, right? So either they pay taxes or they cash flowing even 4%. It's still gonna be a good deal. So you have a 2% spread.
I can't believe we didn't mention seller finance until now. I have 2 seller carry notes at 5% right now, which are beautiful. We write offers at cash, seller finance, and current interest rates. So when we're making an offer, even to wholesalers hate me for it, but we do it anyway. I say, hey, let the owner know if they'll carry it, we'll buy it at this price. And yes, owner carry notes are huge. It's a lot more work,
And you can also offer, higher price.
Yep.
Right, so they can agree on that.
That's it, right? That's your bargaining chip. Hey, and there's another one. I've been talking to this guy for a few months. He's a wholesale acquisition, but we couldn't come to terms on the wholesale price. He wouldn't let it go. And I said, hey, you know what? If you want to carry it for 12 months while we do the rehab, I'll give you 10K more. And guess what? He said, okay, write it up. I'll send it to my lawyer. That's it? For your extra 10K that you wanted? That's actually a better deal for me. So, that's the creative kind of financing strategy talk. It's a little bit more away from what we're talking about now, but if you get I guess the whole point I would say off of this is if you get good at doing these numbers, when you start playing with these other numbers and doing these other creative things, at least you have a solid foundation to root yourself in, and it's easier to kind of branch out and change the numbers around. But when I first started doing this, I was doing all these deals and underwriting like crazy. I still have my original yellow notebook with all these deals underwrote by hand from 10 years ago that I found when I moved 4 years ago. And that was pretty cool to see that. I did the driving for dollars thing that he's talking about. I drove around, wrote down all these addresses, went to the courthouse, looked up the owner, started calling people, did all those things now that you can automate, which is great. But then you couldn't. And so just get good at these fundamentals and you will set yourself up for success. Any other questions? Yes.
How much do you rely on your property manager? Because I find they don't necessarily negotiate prices. I have to go out and find my own people to take care of things just to lower my expenses.
Yeah.
But what advice do you have on that with property management?
There's a couple things that come to mind. I think 3 right out the gate. Interview and hire right. I get to know my property managers, so I take them out to dinner. I know how many kids they have. I get to know them really close. And then the other thing is manage your property managers.
Yeah.
You need to manage your property managers.
Right.
It's not a set it and forget it kind of thing. I'd love to say that's some of them we're kind of at a spot where we don't necessarily need to be checking in all the time. But when you're first building that relationship with them, be clear about your expectations, understand their contract and their expectations. What are you going to do versus what am I going to do? That's where the problems come up, is that they're like, oh, I thought you were going to cover that. No, you're going to cover that, and it's going to cost you more money. Those are the kinds of things that start to cause conflict. The other things that come up are property managers that are growing. I like to see one property manager for every 150 doors under management. My experience is that if they have more than $150 per property manager, it's too much. It's hard for them to handle. There are some tech savvy groups that are kind of coming up that are getting better at that, but they're running in pods. They're not running as property managers. So each property manager has a transaction coordinator, a maintenance coordinator, and pretty much an admin. And so it's a power group of 4 people. So they're able to take like 400 units for that group under one property manager. But that's because that's their model and that's what they've designed. And I'm seeing that work here in California and a couple other places. But it just really starts with building a relationship. This business is networking and relationships. Be a good human, work with good humans, and I think that'll get you a long way. So, yeah. What else we got?
Good question. Good.
Okay. Just a quick note about property management. Yes, there's a 10% or the 8 or 6% here in California, but there's also the maintenance whatever the word is, where they charge.
Upcharge. Yeah.
Right?
Yeah.
There's when they sell a property.
Leasing charge.
Exactly. So there's 50% of the month, or full month, first month. There is, if they take care of your bills for you, means it comes out of your, the money that they receive for rent. They pay all those fees, and then they give you the rest. That's also there. And so there was one case, and this is not, property managers are fantastic people. They give me that, that confidence that I can manage without really being there. So they take care of that burden, that emotional burden. I'm not being the bad guy by telling property or the tenants it's time to pay rent right now. So they cover that part. So I don't have to be the bad guy. And I feel like they deserve the money that they get. But at the same time, I feel here in California, I could not, for the life of me, cash flow with that 12% after I've done the math. I couldn't do it. 12% is way too high, especially in California. It just puts me too negative, and that's the reason why. But fantastic people. They do great work. They deserve the money that they earn. It's just the 12% at the end of the day is too harsh.
Yeah, agreed. And just to kind of piggyback on that, so this is what I was sharing with you tonight is like what I call phase 1 underwriting. What you're getting into is like phase 2 underwriting. That's really getting hard numbers and getting back to the underwriting. You've already made the offer, maybe you're in contract. Whatever that looks like, getting back to the numbers and diving deep. Okay, what's my leasing fee? How do I calculate that? What am I looking at as far as, current deferred maintenance? Now that I've got my home inspection, I know where I'm at there and I can adjust those numbers. That's the next piece, right? This talk is really designed to get that first piece going and really hardwire something. But what I call that is that phase 2 piece, and we use software for that these days, which is phenomenal. But yeah,
I guess just to respond to you, I think if you're a real estate investor starting out, just know it's going to be very expensive for the first 4 properties because they're going to just charge you sticker price until you can do 4 properties. Your home inspector, your general contractor, your property manager, they're all going to charge you sticker price. Once you have 4 different buildings, then you could be like, actually, I'm not paying you the lease up fee. I'm not paying you all of these other things. Or you can go pound sand. And most of them already know. By the 3rd property, they're going to, let's have an arrangement by the 4th property. So you have to get from 1 to 4. It used to be 0 to 1. Now it's like 0 to 4. Because until you get to your 4th property, you're going to be paying sticker price on all of the fees.
all right. What else we got?
Question on the Columbus, Ohio, and was the other market?
Oklahoma
City. Do you only focus on long-term rentals there? Are you looking at flips? How does that look? Or is the deals that you're working with just kind of match the long-term rental?
That's a good question. So for the last 4.5 years, it's been mostly buy and hold with value add. So, something that needed a little bit of love, buy and hold. Our goal is like the 8 to 10 year mark. So whether we're taking it on ourselves or partnering with someone else, getting the agreement that we're going to hold this asset for 7 to 10 years-ish. But since I left my W-2 last year, I'm actually looking at flips in those markets and starting to look a little closer at now's the time to really get in there and do some things. I've seen deals come across my desk that are literally investor fire sales where someone ran out of money and they spread themselves too thin. There's still literally the shower kit is in the box, the drywall's up against the wall. Like they just had to get rid of it for one reason or the next. I'm like, wow, I could get in there and finish that. We have the relationships with contractors in the area. We know that we've done value add stuff before. Maybe we should start flipping. So we've been looking at them. We haven't taken down any flips out of state yet, but we've come really close for the last 6 months. So, but mostly just buy and hold value add stuff. And the value add simple. I mean, it's usually not a crazy remodel, So, flooring and paint and sometimes a furnace here and there, an air conditioner and stuff like that. So.
And do you look at anything above 2 units, like 3, 4, or even in like smaller commercial, 7-unit?
100%. Yeah. So we look at anything 50 units and below, because out of state with 50 units, I can take that down with 2 or 3 partners. You can't do that in California. It's a lot harder. You need a lot more. Well, you could, but you need a lot more capital to come at it. And you don't need to syndicate if you're taking it down with a few partners. So it doesn't have to be a big syndication deal. If it's less than 50 units, you can still partner up. So yeah, we look at anything under 50 units. Columbus is really hard. I mean, a lot of that stuff's been bought up, and Oklahoma City, again, don't sleep on it. It's on the way too. So yeah, thank you. What else we got?
First of all, thank you for speaking.
Of course.
Something I've learned since I started out is just like the importance of knowing how to pivot quickly, to learn from your mistakes quickly. When you look back from when you started, what is something that you wish you had learned sooner or paid attention to quicker? This can be in relation to underwriting, to networking, or just something that sticks out to you.
I'd say getting to know the local codes. I got kicked in the butt really hard once on a remodel, a burr, that was a commercial to residential conversion. And I went over budget like 40 grand. And the only reason we went over budget so much was because we didn't know we were going to trigger certain code requirements. And so that was a rookie mistake that I should have known or learned or tried to learn. And they made us put up a carport and put in fire sprinklers and do all the things. And so by the time you do all that, I mean, you're just out of pocket so much money. The property's still beautiful. It's still amazing. It still cash flows. But it hurt to have to come up with that extra money. And then in addition to that, had to bring extra money to the closing table to get it into long-term debt. So that hurt. So yeah, just I think looking at all the rules and regulations when you're taking down a deal, especially if you're going to do big construction outside of just a lipstick renovation or paint and flooring, really understanding that. And so that's where managing my own projects with subcontractors versus hiring a general contractor kicked me in the butt once. But the good news is we turned one of the units into Airbnb, and it made twice the amount or 4x the normal rent for the first few years. So it helped us pull that money back out real quick. And then the Airbnb thing crashed, and now it's long term. But it's still cash flow. It's a great property. But again, going back to this, just like understanding like what they're going to expect of you, even if you're doing an owner build without a general contractor, is important. And you can do that by what do they call them? What's the appointments with the building department? It's like a plan check appointment with them. So you go in there and you have the conversation. Hey, I'm looking to do this. Here's what I'm thinking. And they're gonna be like, oh yeah. And then you also got to go to the zoning department and check zoning. That's where the hiccup was on this. it wasn't with building. We talked to them. They're like, yeah, go for it. Looks great. Then zoning picked up on it that we were converting from commercial to residential, and it changed the game. And we were already in it. And so it was too late.
How did you come up with the money?
Which,
4K.
I think I borrowed against my retirement account. Yeah, which is a powerful tool if nobody knows how to do that.
I had a,
You know, like,
yeah, I just had it similar to just having to renovate my commercial property. I had to do came off of my HELOC, my primary home. So yeah, you do have to pivot sometimes.
Yeah.
Find them.
and it's great. I mean, that was a long time ago. That was like 6 or 7 years ago. And the property still does great, you know? And so it's like, these are the lessons you learn, you know? And hopefully I can share that with you so none of you have to deal with that. But that one hurt, you know? But we still have the property is still performing, and it's a great one.
I'm dealing with an issue. I'm sure some of the folks in this room are as well. Starting January 1st, once you have someone file an application, you have to take it off the market and wait for them to. It's a real freaking bear, and it's like I'm dealing with that right now. I don't know if you know what I'm talking about, but you have to take it off market while they do the application, and you can see if they can, find, if they're able to finance it or not. It's a ridiculous. I mean, it's almost socialism. I mean, it's not the free market anymore in California, and it's really, really difficult. I don't know if
Are
anyone
you
has any
referring
advice.
to a sale or when you rent?
No, this is just rental application. So if you take, someone says, yeah, I'm going to rent your place. I have this twice over this last month. And the person says, yeah, we're in. They came, visited, loved it. Of course, they have beautiful homes. And they're just like, no, they couldn't make it. And then they had another person in line. They had a second applicant that I still can't put it back on the market until the second applicant. So it's a real problem for investors.
Let's chat after this. I got
I
something
don't know
for
if
you.
anyone else has
Yeah.
any advice on that.
Well, let's just say that's why I started investing out of state.
Yeah, right.
So, that 5 years ago, I was watching the laws start to change dramatically in California, and I love it here. Don't get me wrong. Like, I love it here. We'll probably live here forever. But, it's just really hard as an investor to have less and less control over your investment, for whatever reason. And so that's why we started investing out of state. So.
Yeah, I mean, I see it, but I do the sweat equity stuff, right? So it's harder for me.
Yep. What else?
Any more questions?
It'd be even worse in California if the majority of the legislators were themselves property or rental landlords.
Yes, right.
So, they don't want to do too much that's going to come back in their face.
Right. Awesome. Well, thank you for listening to me for the last 45 minutes or whatever. I appreciate you guys. If you're ever in Santa Rosa, come check out our meetup. We have a lot of fun there. We have great speakers as well. If you're ever in that area, please hit me up. The QR code on your little sheet doesn't work, so if you want to connect with me, that's the one you want to use. Or just come talk to me. I'm a human just like you. Let's network and talk real estate and have some fun. Thank you.
Give a big round of applause to Wayne. Wayne, thank you. And thank you everyone for coming out. We'll just move on to networking after this, and we'll meet again in about 4 weeks in January. So make sure, July. Make sure to again scan the QR code, sign in, so you'll get email updates regarding that as well. Thank you for coming out.